But now, why multifamily over the stock market? I've heard some awesome things about the stock market. Why don't I just focus all my time there? Well, let's talk about leverage number one. So multifamily, I can leverage up to 70 to 80% of the cost of the asset and still reap 100% of the benefit of the asset. That's the best part, right? Stocks, you can do some stuff with margin, but it's capped at about 50%. And real estate, sometimes I can even do more than 70 to 80%. Sometimes I can even get 100% if it's a construction loan. You can do a lot of different things with real estate leverage. So you're able to have a lot more purchasing power, and you're able to actually utilize 100% of the benefits, whether that's tax benefits or income benefits. You're still able to utilize 100%, and you're only having to put down 20 to 30, which is a pretty awesome trade. And not only is that leverage available, it's also very good leverage in multifamily. So it's non-recourse leverage when you're using agency debt. And so what non-recourse means is basically that I am the borrower, right? And I'm not personally held liable beyond the actual debt or collateral that I have on this specific loan. So if I buy a multifamily unit, let's say a 50-unit multifamily building, and I default on it, worst case, I end up in that very small 0.4% of people who lose their property. Well, the bank's only going to be able to take that specific property. They can't touch any of my other assets. They can't touch my personal property. All they do is take the collateral for that loan, which is the building itself. So if you're an investor and you have 5 businesses on the side and you want to buy one 50-unit property and something really horrible happens, you end up being in the 0.4% of people who lose it. They're only going to take that specific 50 unit. They're not going to take your other 5 businesses. They don't do that with non-recourse. And the other added benefit is, let's say you buy that 50 unit, and then 6 months later you want to go buy a personal residence. Well, guess what? It's not going to show up on your personal financial statement as a liability. So when you're going to get that new loan for your primary residence, it's not going to show up that you have some massive loan out against you as a liability. It's only going to show up that you own a lot more real estate now as an asset. So that's a huge benefit of non-recourse there. And again, feel free to ask questions in the chat or in the Q&A boxes during the thing. I'd love to interact with you guys if possible. And then we're also going to have a Q&A at the end, but it's always fun to do it during the middle as well. So we have the stock market versus multifamily as far as returns. So the average annual return for the stock market since 1950 is around 7%. And I was pretty generous with the stat. Like I found a lot more worse stats. I could have said this was 5%. There's several sources that were pretty keen on 5%. And I decided to be a little bit generous because I didn't want to hear any of the other stuff. Like I could factor in fees and inflation and bring this down closer to 5, which is what a lot of people do. But I'll just leave it at 7 because I want to be nice. And so the benchmark of most average annual returns for multifamily, or at least the ones that I'm doing, are around 20%. And I'd say that that's pretty standard across the industry, which is the average annual return you're looking for is going to be around 20%. And that's not counting the tax savings that real estate gives you against all your other income. And we're going to talk about those tax savings here in a second. So not only is the returns better, but that's not even factoring the taxes, which we're going to talk about here. And the stock market, when you're selling stocks, you're going to pay 100% of long-term or short-term capital gains. So short-term is when you hold it for less than a year, and you're going to pay capital gains tax based on your ordinary income bracket. And if you have a long-term game, you're going to pay approximately 15% tax. So you're going to be paying taxes on any capital gains in stocks. But multifamily, we're actually not going to need to do that. We can defer it through a 1031 exchange, which we're going to talk about here. So when I sell something in real estate, if I buy more real estate with the real estate that I sold, the profits from that sale, then I'm able to actually defer the capital gains. So I'm not going to be paying taxes on that. I'm going to kick the can down the road, and I can do that until death. So you essentially don't need to be paying taxes or you can be deferring your taxes, I guess would be the proper legal term there, on your profits from sale. And then also, we have depreciation against the profits during the hold. So even while we're holding this thing, we should actually be able to offset a lot of our earned income, and that's going to be an amazing thing to do. So let's say, my question may be an end question, but what do you think about Canadian real estate? Because I contacted a successful real estate investor of my area, and he said that the average cash flow for an apartment complex is $50 to $70. So what do you think? Well, I'm assuming that he's saying per door, the average cash flow is around 50 to 70, and that's not too bad. Typically in the markets that I'm in, it's around 100 to 150. So that seems like it may be a little bit hard pressed for cash flow, but I don't think he's saying that the whole complex is only going to give you 50 to 70 bucks a month. I think he's saying per door, you're going to be making 50 to 70 a month, which is actually not too bad, especially if you, let's say, have 100 doors, then that becomes a pretty decent number. So thank you for the question, Miguel. Let's get into depreciation. So the current value of the property is $1 million. So basically what we're going to be able to do here is the IRS says that your property is going to become fully depreciated in 27 and a half years. So we can divide our value by 27 and a half and we get our annual write-off. So here's $36,000 that we get to write off against our tax liability for the fiscal year, every single year. And this is just basic depreciation. So if anyone here paid more than $36,000 in taxes last year, how would you like to not do that? That's the kind of awesome thing with multifamily and also real estate in general, but predominantly multifamily. And for the reason that we're going to talk about next, which is cost segregation. Because in cost segregation, this really only makes sense to run a cost segregation study if you're going to save a significant amount of taxes. And the only way you save a significant amount of taxes on cost seg is by having a lot of property or a lot of scale. And so that's why multifamily is a good situation. So basically all that cost segregation is that $1 million value we just talked about. We're basically going to argue here that that value doesn't come just from the structure. It also comes from these two categories as well, meaning the land improvement. So the improvement we do to the land, we're arguing that some of the value comes from that. And also we're arguing that some of the value of that building comes from the personal property as well, which is totally fair, right? Appliances, cabinets. And so these are the two categories. Land is 15 years. Land improvement is 15 years. And personal property is 5. So essentially, we can separate about 30% of that $1 million and claim it as being comprised of these two categories, land improvement and personal property. So that 30% is 300 grand. So we can take that 300 grand and put it into these two categories respectively. So same $1 million property, but now we're doing a cost seg study. And so we've deemed 20% of the building's value comes from personal property, which as you remember is on a 5-year scale. So we take that 20% of 1,200,000 grand, we divide that by 5. Now we're already at 40,000, which is above 36, and we are only 20% way through here. So that's pretty awesome, because if we just leave it at regular depreciation, we're stuck at 36,000 annually, but now we're already up to 40,000 annually, and we're only at 20% of the property's value. So now we still have 10% here in land improvement, divide that by 15, we get an extra 6,600. So now we're 10,000 over the other one, and we're only 30% through. Then we get the remaining 70% on the regular schedule, and that's going to give us an extra 25,000. So now we've doubled our annual write-off. So now you can write off 72,000 against any taxes that you owe annually, which is pretty awesome. So not only are you making all those returns that we talked about, the 20% average annual return, you're also going to be able to save all of the tax money that you're usually paying. So let's say you're like a doctor, right? And you're making 200 grand a year, and you're paying somewhere around 50,000 a year in taxes. You're just losing that part of your income. Well, now not only are you going to make 20% annually on the investment that you give to the real estate or that you put into real estate, but you're also going to save all of your tax liability because you can write off 72,000. That actually leaves you with a $12,000 loss for the year. So you're actually going to be able to make the 200 grand that you are actually being paid. You're not going to have to lose 50,000 of it anymore, which is a completely huge added benefit that's not factored in to the returns. So that's pretty sweet. But let's talk about inflation. So rents keep pace with inflation historically, as you can see here. Since 1965, it's been well over. But also, let's say that hyperinflation happens and that it doesn't keep up with rent and somehow it just blasts through it. Like we have like a South American Venezuela kind of hyperinflation where $1 million only gets you a cheeseburger for something crazy like that. And that's kind of what we're saying here. And what would happen would be your mortgage would actually stay the same dollar amount. So in that really crazy, very rare or unique scenario, we would actually just be able to pay our mortgage off quicker because the dollar amount would stay the same, but the dollar would become so valueless that mortgage would be paid off very quickly. So Stella asks, what happened to those write-offs after I sold the multifamily? So there's a recapture that happens to those write-offs, but if you do a 1031, which is the thing we talked about with sale, so you sell that real estate, Stella, and you buy more real estate with it, then you're able to defer the recapture as well. So you're deferring all of the taxes. And eventually there will be a massive recapture, but if you keep kicking the can down the road until you die, then there isn't going to be that recapture, right? So that's something to think about. And it actually gets reassessed at your death, so your kids won't have to worry too much about the recapture either because it'll get reassessed. So you can keep kicking down all of those defers down the road, and then never pay them. So